Tom, thanks for being with us again. We've been talking with you all year about the impact of COVID-19 on the economy in all its dimensions, from growth to unemployment to federal spending and deficits to interest rates, et cetera. What we wanted to do today was kind of step back and get your take on where we are as we start to close out 2020 and look ahead into 2021.
Great. I'm looking forward to it.
We try very hard not to be political in these videos, but I do want to start out asking about the presidential election. Who's in the White House does matter to the economy. What do you think the biggest impact of the election is going to be on economic policy in the coming year?
Well, it's a great question, and I know we're all thinking and talking a lot about it. There'll be a lot of Thanksgiving, conversations on this matter. And in our form of government, with power divided between the three branches, who controls them and what their policy views are matters a lot, as implied in the question. I think the presidential election results are clear. The policies that President-elect Biden has articulated are clear, and they're quite different from the policy frameworks and perspectives of the Trump administration. But their ability to prosecute that campaign, if you will depend significantly on the results of what happens in the United States Senate runoff elections in the state of Georgia, right? Because as we stand right now, it's 50-48, if I got my math proper. And if the Republicans end up in the majority in the United States Senate, it will be a classic example of divided power, and it'll be a lot harder for the incoming administration's preferences to be legislated on. So that we don't know the full answer until January 5th, when those runoffs for those two Senate seats in Georgia occur. But the prescriptions and policy preferences of the incoming executive branch are pretty clear, and they will be a pretty dramatic shift from what we've been used to for the last 4 years.
What do you think is going to be the biggest single change, setting aside the issue of divided government, just at the White House level?
At the White House level, I think it's clear that they will be more willing and able to be fiscally expansionary. They're going to want to spend money on things and do new programs. I think it's clear they will also reverse by executive order a whole variety of things that have been done by the Trump administration, where executive action is a tool that is available for them. That could manifest itself in places like environmental rules around the Environmental Protection Agency and things of that nature. So I think we'll see a flurry of dramatic and prompt action after January 20th. But the legislating sausage-making process will be more time-consuming and more complicated depending on what happens in the Senate runoffs.
Okay, so let's turn to the economy. One of the themes that we're going to cover today or talk about today is that the way the economy has performed, while it has been severely impacted by the pandemic, things have gone maybe a little bit better than initially expected. And let's bring up a slide here. What this shows is the contrast between what the Congressional Budget Office projected for economic growth by quarter at the outset of the pandemic. That's shown in the blue bars. The green bars are how the economy has actually performed. And as you can see, in the first and second quarters, there was a pretty tight correlation. But in the third quarter of this year, the economy rebounded a lot more strongly than was initially expected. What do you think about that?
Well, I'd say a couple things. Number one, being a really good macroeconomic forecaster is hard under ordinary circumstances. Being good at it and therefore being accurate in your projections in the environment of a pandemic like this is really hard, right? And so we shouldn't be surprised that the variation between expectations 6 or 9 months ago and the realities today. And the realities today have been significantly affected by things that we're not used to understanding how they work too. One of which is easier to understand, which is monetary policy, which has been very accommodative and very consistent and very dramatic. The other, which is harder to predict because it depends on politics and the process of politics is the fiscal policy situation. And we've had a couple of fiscal packages to deal with the economic consequences of COVID. And those combined with the wide array of public health responses at the state and local level across the country have meant that the economy rebounded quite a bit more than everybody expected in the spring. Now, what we all are going to ask ourselves is, well, where do we go from here? To which the answer is it very much depends on the trajectory of COVID-19, which is going to certainly get worse before it gets better, and how policymakers respond to that. And their ability and willingness to provide additional fiscal stimulus and support to the economy as they have this year that yielded these results will be, as we just described, a consequence of the political dispensation within the United States Congress and the executive branch.
Let's bring up the next chart, which is a similar picture. It doesn't show GDP. This one shows unemployment rates. Again, CBO was projecting unemployment of around 15%. This year after the pandemic got underway. It's been much lower than that in actuality. Again, what do you think about that?
Well, you can't look at this and feel anything other than a sense of relief and good feeling about the fact that the unemployment rate is substantially lower than official prognosticators expected 6 or 9 months ago. And the fact that we've gotten down to these lower levels substantially faster than expected is good news for the economy, clearly, and good news for millions of our fellow citizens who are employed rather than unemployed. So we should all take some comfort and some confidence in that. But I would also say that the low-hanging fruit has been picked to a large degree. And so depending on the trajectory of COVID and the response to COVID, we're not likely to see that 6.9% go down to the pre-COVID levels of 3.8, which was the lowest in my lifetime, anytime soon. So I think the CBO may be a little more optimistic today than they were in the spring, but the difference between 6.9 and 3.8, that's going to be a much harder thing to achieve.
Let's turn now to asset values. We'll bring up another chart. This shows the three of the major stock indices, the S&P 500, NASDAQ, and the Dow Jones Industrial Average. As of today, which we're recording this in mid-November, all three of those are at a higher level than they were at the beginning of the year. I think a lot of people would be surprised by that. Are you surprised by that?
I am. Like many of my fellow citizens, I have a 401k, I'm a saver, and I'm an investor in the stock market. I would not have expected us to be at the levels that we are at. But let's be clear about what the stock market is and what the stock market is not. It is from the economy, but it is not the economy, right? It's just the aggregated valuations of publicly traded companies. That's a big chunk of production in this country, but it isn't the entirety of the economy. And it has been substantially aided by the highly accommodative monetary policy implementation of the Federal Reserve, which has pushed an enormous amount of sustained liquidity into the economy, which is always helpful to drive up both liquidity and prices in the securities markets. But it's also a reflection of the fact that investors are valuing companies on any given day, and therefore the aggregated value of the stock market on the basis of the future value of the earning streams of these companies. And people are looking kind of through COVID into the long term and saying, what am I willing to pay to buy the future value of this company? And so it's always a more optimistic indicator than where you are in any given day in the true macroeconomy.
So let's go to the next chart. This one shows housing values in the 20 largest U.S. cities. Again, they have continued their upward progression through the crisis so far. Does this surprise you, and what does it mean?
I'm not sure it surprises me, but it demonstrates something that's really interesting about COVID and its consequences, right? If you think about the store of value that is owned by the population of the United States, a lot of people own some shares and some securities in their 401k or what have you, which is why we talk about the stock market. But the biggest store of value for the vast majority of Americans is property, right? It's the home that they live in. And when you think about COVID, it's, hey, this is a communicable disease. What's the best antidote to COVID? Well, stay home, stay away from other people, and take other safety precautions to protect yourself and your family and so forth. And people have done so. They've stayed home, they've worked from home, they've done all these things, and therefore your home just became more valuable to you because it's also a safe place. It's also now your new office for those of you who can work remotely. And it's no coincidence, therefore, that people have been spending an enormous amount of money fixing their garden or doing other DIY work or having an addition put onto their home or what have you. Or if you live in San Francisco or Chicago or New York, you're thinking about buying a second home in the country so that you can spend more time out of the urban environment so that you can be socially distanced from everybody on a structural basis. All of those things have portended very well for the real value of houses, right? And so I'm not the least bit surprised that the inexorable march since the great housing collapse of 2008, 7, 8, 9 continues, and in fact has been probably accelerated, and demand has increased for houses because your house is a great antidote as part of your health and safety regime in a COVID environment.
Low interest rates also help.
Low interest rates help asset values generally. They clearly help here, and it's made it easier for people to borrow money, all other things being equal, and the cost of doing so, which further drives up valuations for property in the same way that it drives up valuations on the stock market for companies.
Let's bring up one last chart. This shows delinquencies for consumer credit in all its forms over a fairly long time horizon, dating back towards past the Great Recession. But as you can see here, they've continued to go down, and they're much lower than they were after the Great Recession of 2008-9. Does this surprise you?
It's really interesting because in our conversations this year, we've talked a lot about public debt and debt issues and so forth and so on. But when you look just at the consumer slice of the consolidated U.S. economic balance sheet, this is really interesting. And the reason for it is part of the consequence of COVID is we're social distancing, we're staying home, we're working from home if we can, we're doing all of those things, which means we're not out shopping, we're not out going on vacations in the way that we were, we're spending less money, and so unexpectedly the national savings rate, which is a whole nother topic for another day, has gone up dramatically. Even though unemployment is higher and we've had a recession and everything else, people by and large, they're saving a lot more money, right? And they've had an opportunity to strengthen their own personal or family balance sheet, pay down some credit card debt, do some other things, save more money and the like. They've also been aided and assisted by a variety of types of forbearance from their bank, from their credit card company, from the lender for their auto loan, you name it, right? And so to a certain extent, that big step down at the end of this graph here is a little bit of an apples to oranges comparison because there are certain types of forbearance and things that are going on in the market that are not normal, that are giving people some time to not make payments and so forth because of the stress of COVID. So over time, I wouldn't expect that to continue to be ratcheting down. And again, as with some of the other graphs, the question is, well, what's this going to look like in 6 months, 12 months, 18 months, right? Depends a lot on the trajectory of COVID, which, as I say, is much more likely to get worse than better, at least in the short run, and the ability and the willingness of the federal government to continue to provide some fiscal support to the economy to mitigate the negative effects of the raging of the virus itself.
Last question, Tom. Recognizing that we're still in the middle of this and we don't know what lies ahead, what is your take on how the economy overall has performed this year? Is there reason for some optimism here about how resilient the economy has been throughout this crisis?
So a couple things in response. Number one, I'd be remiss without saying, in the long run, I'm super bullish on the United States. We have the most flexible, most innovative, most adaptable economy in the world. I expect that to continue to be the case. And I think what we've seen this year, despite all the difficulties and the stresses and many, personal tragedies for people who've lost their jobs and so forth, the economy has actually performed reasonably well, demonstrated a lot of resiliency and flexibility, and some of our macro indicators, as we've talked about today, are better than any of us would have expected, if we were having this conversation 6 months ago. But I would tell you, in the same way that in 2007, 8, and 9, when we had the catastrophe of the great financial crisis, we did extraordinary things as a country in fiscal and monetary policy and other structural changes to deal with that. But it was still a really awful experience, right? And so when the Treasury Secretary or the Chairman of the Federal Reserve or even the President of the United States says, well, it could have been worse, it usually doesn't make you feel that much better when you're having a bad experience. But I'm here to tell you that that's also true right now. It definitely could have been worse had we not had an aggressive Federal Reserve who took the necessary measures promptly, comprehensively, and are still doing so. It definitely would have been worse had we not had the executive branch and the Congress come together and do several rounds of very aggressive, serious fiscal stimulus. And I think as a result of all of those things, we've done better than we otherwise would have done. But we still have a lot of issues, right? We still have a lot of unemployed people. We still have a lot of industry sectors in particular that are really suffering now and that will continue to suffer until we get to the other side of this COVID-19 pandemic. So it's a little bit of glasses half full. We've clearly done a lot of things well and outperformed our own expectations, but we clearly have a long way to go. Because as I've said since the beginning, we're not going to be out of this until we have a ubiquitous, effective vaccine that's distributed and utilized across the population. And we're a ways away from that. And even when we get through to the other side, there'll probably still be some structural changes to the economy and the way that we do business together, the way that we live and work, which will help certain sectors of the economy and harm some others. So there will be some long-term structural changes. But as I say, this is an immensely productive, adaptable, and innovative economy, and we turn and change and adapt really, really quickly. We've been doing so. I would hope and believe and expect we will continue to do so, and that's good for us all.
Tom, thank you so much.
It's a pleasure to be with you as always, Arthur. Thanks.